All right, welcome to another episode of Asset Coach and Tax Strategist. I'm Robert Wolf. I'm the CEO and founder of Terra Firma Business and Financial Consultants. I'm an asset coach and tax strategist. If you're not sure what that is, go ahead and take a look at some of our other video and contents on this channel. If you're a subscriber, thank you so much for subscribing. If you haven't yet, please consider subscribing, or giving us a thumbs up, or adding some comments as other content or information that you're curious or interested to learn. So I'm going to do a quick disclaimer on this particular episode, as well as we're going to start a series called Financial Distributors, and we're going to talk about who we consider the three financial distributors, break down some products and services that they offer, some rules, regulations, and all that fun stuff. Why is this? Well, if you remember economic termites, one of the termites was laws and regulations. And regulations and laws, our politicians create rules, laws, regulations, and not all the times do we get to vote on those. Yes, you can make the argument, well, you voted them into office, so therefore you voted for these. BS, but at the end of the day, they do pass these laws, these regulations that affect us and eat away at our wealth. And so if you're not sure what economic termites are, go check out my series on that based on the book I wrote called Economic Termites. The financial distributors are in my other book, Farming Assets, and we touch a little bit on in economic termites, but in farming assets book, we talk a little bit more about that. So disclaimer, what is that? Sorry, I get a little excited about this stuff. We're not giving investment advice here. We are just giving you educational and informational content here. Just giving you an overview of what is out there, what you can and cannot do, or whatever the case may be. We don't know your particular situation. If you're interested in us, then reach out to our team. See if you qualify to be a member of Terra Firma, and what's that mean, and what's our process, and what's included in membership. That's not what this episode or this content of this channel is about. So without further ado, let me go ahead and share my screen. Let's talk about this and start diving into what is what is farming assets, and more importantly, our content today is what is a financial distributor. All right, so let's share my screen, and we should be able to see my screen here. There we go. Boom. And my little video up in the top corner. Yay, there's Bob. All right, so what is a financial distributor? Financial distributor is basically a company or institution that offers financial products. What would be considered financial products, we'll talk about in each of these. But who are financial distributors? Well, banks, investment companies, and insurance companies. Those are the three industries or areas that create product for us from a financial perspective that provide us what we are able to invest in and grow assets in. Okay. Now, what's the purpose of each financial distributor? That makes a big difference in understanding what kind of product or service you're looking for. So banks, really, the key here is leverage. Now, banks, as we'll go into, offer other products and services, but the key is to create liquidity. We put money into a bank, it creates liquidity for them so they can lend that money out, and that's how they make money. But for us, we use it for leverage. Okay. And if you remember my 5Ds or my 3Ds, when we talk about the stages of assets and the 5Ds, the fourth D is debt, which is leverage, which incorporates banks. But you can have debt in other areas. So if you're interested in what that particular episode is, go check that out as well. So investment companies represent risk, the ability to appreciate or hedge or stay ahead of inflation, grow and expand. So we'll talk about what that looks like. Now, when I use the word investment companies in the investment world, there's a specific term for investment companies, but we're going to step back and look at a more of a broader terminology of what companies are that offer a variety of investments and what those look like. And we'll do that in this series here. And then insurance companies really represent safety, protection, right? That's what insurance is about. You have home and auto. But the reality is, like auto insurance, for example, when you're looking at insurance in general, we're passing or exchanging the financial risk to a larger entity than us self-insuring, so to speak. You'll hear that terminology. But from a wealth perspective, what's this mean? Now, most of the time we think about insurance companies, whether it's home and auto, or if you're a business owner, liability, property, workers' comp, health insurance. You can look at it life insurance, disability, long-term care, annuities. There's a whole bunch of products, which is why they're a financial distributor. They offer all these products and services. Okay, so before we dive into that, let's discuss what an asset is, first of all. Okay. An asset is a resource with economic value that an individual, corporation, or country owns or controls with the expectation that it will provide a future benefit. Okay. Now, assets are reported on a company's balance sheet and are bought or created to increase a firm's value or benefit the firm's operation. Okay, so now the balance sheet not only has assets that we're talking about, but it also has liabilities. And what do these have to do? They have to balance on the balance sheet. Shocking. But that's the whole point of it. Okay. So we'll talk about this when we start kind of diving a little bit more into the banking side, loan side, and leverage side, so to speak. An asset can be thought of as something that in the future can generate cash flow, reduce expenses, or improve sales. Okay. Now, what's a liability? A liability is something a person or a company owes, usually a sum of money, so from a financial perspective. But you can be indebted to somebody. You could have lent a lawnmower to your neighbor. Your neighbor is indebted to you to return that. And if it breaks or they break it, what do? They're indebted to replace it, right? So because that's your property and that's your asset that you use to mow your lawn, you lent it to them so they can do the same as well. So therefore, they're indebted, or that's a liability to them. Liabilities are settled over time through a transfer of economic benefit, which includes money, goods, or services. Recorded on the right side of the balance sheet, liabilities include loans, accounts payables, mortgages, deferred revenues, bonds, warranties, and accrued expenses are some examples. Now, banks equal leverage. Okay, so let's talk about this. What's that mean? Well, pre-COVID, back in 2018, you'll see that banks were required that had more than 122 million in their net transactions accounts. It's a liability. So you would say, wow, man, if I had $122 million, that's a lot of money. My net worth would be great. That's an asset. But to a bank, holding on to cash is a liability. They were required to hold on to 10%. Okay. So in this case, it was just 12.23 million. Okay. Now, why is this important? Well, this is important because when you look at this particular category and you understand how a bank makes money, well, by lending. So if they're required to hold 10% in cash, what are they not making? Money on that 10%, but they are making money on the other 90%. So the average person would be saying like, well, don't be so greedy, right? But hang on, what happened in March 2020? That's right, COVID, right? World pandemic. The world is ending. This will be worse than the Black Plague. Okay. So what happened? The Federal Reserve, the board of governors of the Federal Reserve System, they're the banking system, right? The central bank of the United States provides a nation with a safe, flexible, stable monetary financial system. That's what they say they're supposed to do. Okay. Now, on March 15th, 2020, when the world shut down. So, as announced on March 15th, The board reduced reserve requirement ratios to 0%. You're not seeing that wrong. 0%. So that 10% safety got moved away. That was effective March 26th. This action eliminated reserve requirements for all depository institutions. Oh, wow. All right. So, what'd that do to the risk? Well, it increased it. What do you mean by increase the risk? Well, that means the banks don't have to hold any cash on hand. They can lend it all out. So there is no safety net. Okay. Well, isn't that good? For who? Technically, if there was a run on the bank, there is no cash, there's no liquidity. Okay. So this is important because today, when you look at the government and how they track money, they have M1, M2 money, that's short-term, long-term monies. If you look at CD banks today, so CD rates today, if you go to your bank today, and so that's the time of this recording. This is we're in October 2024 when I'm recording this. And so if you were to look at the banks today and go onto your local bank and look at CD rates, okay, or call them. Typically, in a normal economy, when there's more liquidity in the economy and there's more security in the economy, you have long-term CDs, certificate deposits. We'll talk about this in a minute. The interest rates would be higher, right? Because they're holding on to your money, and so as a return, no. But what does the liquidity need to happen? They need liquidity, so they need cash. So if you look at 90-day, 60-day CDs, those rates are higher than 3-year CDs or even 12-month CDs. Why is that? Because they need liquidity. So if you put money in, they're enticing you to put money in there in a short-term depository. Okay. So we won't go all of that depth here in this episode. Okay. Investment companies equal risk. So an investment company is a corporation or trust engaged in the business of investing pooled capital for investors in financial securities. This is most often done either through a closed-end mutual fund or an open-end mutual fund. Now, this is what an investment company is called, but what we're going to be talking about in our series is more of a kind of a generalized investments, okay, in the products and services. But this is important to understand because the majority of people in their retirement accounts are in these types of mutual funds. So this is very important to understand. In the US, most investment companies are registered with and regulated by the Securities Exchange Commission, the SEC, under the Investment Company Act of 1940. So this has been around for a long time, right? We're embarking pretty close to 100 years on this, a century on this particular rule, this act. An investment company is also known as a fund company or fund sponsor, which is basically sponsoring a mutual fund. What's a mutual fund? You as investors are pooled capital investors, pooling your funds mutually into this product to invest in a bunch of companies, public companies. Okay. Let's see here. They often partner with third-party distributors to sell. So there's third-party distributors, people who sell these types of mutual funds, and we could talk about this another way. So what is an investment company? That's what it is. So let's look at why we say it's risk. Well, Vanguard says the performance data shown represents past performance, which is not guaranteed of future results. Investment returns and principal value will fluctuate so that investor shares when sold may be worth more or less than the original cost. Guess what? Vanguard told you, check the box. They've done their job. They are compliant with the SEC. They told you you're taking risk. There's no guarantee that you're going to make money. Fidelity. Before investing, consider funds, investment objectives, risks, charges, and expenses. A contact for a prospectus, summary prospectus. Past performance is no guarantee of future results. So this is when you end up talking to your financial advisor or you hear different things, you're going to hear words like risk tolerance or balanced portfolio, diversification, asset allocation. These are all processes within reducing the risk of this, but not eliminating the risk. And that, quite honestly, there's risk in pretty much everything, including cash, just money sitting in your checking account because of inflation risk or interest rate risk. So there's risks, so to speak, in everything. But specifically here, you're purposely taking more risk within these guidelines of understanding your risk tolerance, your portfolio being balanced and diversified and is different allocation of assets, okay, to reduce that risk, but you're still taking that risk. The less risk you take, the less potential return. The more risk you take, the greater potential return, but also on the flip side, losses, right? So that's what risk is, okay? So that's what they're saying here. Now, within insurance companies represents safety. An insurance company, what is it? Is a contract. Oh, contract. We didn't see that terminology with banks or investment companies. But insurance is a contract that represents by a policy, which is a contract. So these go hand in hand, okay, in which an individual or entity receives financial protection or reimbursement against losses. And they receive those funds, that protection from an insurance company. That's the purpose of what they are. The company pools clients' risks and payments into more affordable. So if I have auto insurance, all the people with auto insurance with that insurance company have premiums there. Well, Bob, I bundle my coverages. Okay, great. And you have homeowners insurance, I'm assuming. So then you have homeowners insurance, and all homeowners insurance with that insurance company is bundled together. Okay. Oh, but I also have umbrella. Okay, great. You have umbrellas and all of your premium that from all the other investors. Boom. Okay. They pool it. Okay. Well, what about workers' comp? Pooled. What about health insurance? Pooled. Okay. Pooling is a very, very important tool that is used by financial distributors. Very important term. And it's a great tool for you and I to build our wealth and reduce our taxes as well by understanding the phenomenon of this word. And it's not just a word, it's an action. Pooling is an action. By pooling your funds, pooling your financial resources, by pooling other people's financial resources into an overall pool, collectively, you could have the potential of reducing risk, but increasing wealth because of the type of thing, investment, or product or service you're pooling your funds to go create. Okay. This is very important terminology. Okay. Insurance policies are used to hedge against the risk of financial losses, both big and small, that may result from damage to the insured, which is you, the person who's purchasing the contract, which is a policy for their property, or from liability of damage or injury caused by a third party. Okay, that's very, very important. Now, why do we say there's safety? Well, because there's something called capital and surplus or reserves within an insurance company. It's essentially the amount of money needed and remaining after insurers' liabilities are subtracted. Okay, so what's that mean? Well, an insurance company receives premium. Okay, so they receive premium, and that premium is to protect from losses. Well, those losses are coverages. So if it's life insurance, it's for death. If it's disability, you're unable to do certain, you become disabled. If it's an auto or home or whatever the case may be, and then whatever's left, well, those premiums go into a bucket called reserves. Okay. And these reserves are broken down into capital and surplus. Okay. And so if there's a loss, money will come out of the reserve to pay the loss. If there is no loss, the reserves are held on by the insurance company as an asset. But it's both sides of the category. So if you have assets on the balance sheet and liability, you're going to have a premium, cash, asset. And then on the insurance companies, they're also going to have liability. It's going to balance each other out. Okay. All right. So the surplus is a financial cushion that protects a company's policyholders in the event of unexpected or catastrophic losses. So an actuary, which is somebody who in insurance world, it takes all these numbers and they're actually computing the potential risk based on data already received within the industry and within that particular company for that particular risk. They take all this data points and that's what they create as what's the projection of loss. How many people are going to get an auto accident? Based on that, what region are they in, and what should we charge for premium based on that risk? Right? It's a financial sharing. So I buy a policy, which is a contract. I pay a premium. By doing that, the insurance company agrees in that contract to pay for that financial loss if that loss were to occur. That's why I'm paying a premium. That's why it's a contract. Both parties are agreeing to that. Okay. Now, within California, for example, and I use California because they tend to be the most I don't know. You fill in the world. You guys are watching this. You know California, okay? So I don't need to talk about that. So, but here's the thing. This is interesting. So within the insurance, so we talked about investment companies, the Securities Exchange Commission, the banking industry is based on the Federal Reserve, okay? Now, insurance is based on each state and their insurance commissioner. Okay. Now they have a National Association of Insurance Commissioners, NAIC, that they all agree to baseline rules, but each state is in charge of their own rules and pricing and everything else, capitalization and surpluses for that particular state. They're in charge of that, the insurance commissioner. Okay. Most people don't really care. They vote for an insurance commissioner, but they have no idea what they're voting for. It's a box checked or left blank, but either way, somebody is going to be an insurance commissioner, period. They're running the entire insurance business for the state. Okay. Now, by doing that, as you can see, there's different types of risks and coverages: life and disability, title insurance, fire insurance, marine, surety, disability, so on and so forth. So a ton of different, and they have capital. So the capital the insurance company is holding on to. So if they have at least $2.25 million, they need a surplus of at least 100% of capital. So that means their surplus needs to match their capital. Ooh. So if I'm offering life insurance, I need, as an insurance company, if I have $2.2 million, my surplus needs to be $2.25 million. Safety, financial security. Okay. Very important products and services to have in your overall strategy to help increase your wealth and reduce taxes at the same time if it's used correctly. But financial distributors offer this. Now, they offer all of these. Banks, investment companies, and insurance companies offer all of these products and services both to the personal as well as the commercial or business side. And it's big. It's big. It's a huge opportunity for you and I as wealth builders, as asset builders. Okay. As long as we know about it. Okay, so this is that first episode, give you an overview. The next episodes are going to dive a little more into each of these. Okay, we're going to do some Google searches. We're going to look at Investopedia. I find that tends to be the best place that's easily accessible by everybody. But we'll dive into that. It has links. You can take a look at those links. You can do your own research. That's what I'm trying to do, is provide content. So if you want to dive more into the weeds, create questions, reach out, that sort of stuff. That's what I'm going to try to accomplish in the next few episodes. So thanks so much for joining us. Again, if you haven't subscribed, please subscribe. This content is designed to help you build wealth, reduce taxes, as an asset coach and tax strategist, looking at the rules, the kind of the game to the rules to the game, and understanding those rules so you don't get played by the game. You can play the game. Thanks so much. Make it a great day.